Good afternoon, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hope all of you had a very good day of trading today. And in today's markets, guys, well, it was definitely a day of everything and the kitchen sink being thrown at us. Crazy day in terms of volatility. Take a look at the VIX. The VIX, as a matter of fact, today was up over 20% at one single point in the day, which is a significant level, guys. We had not seen that since the early portion of September, where we got some bad economic data. The same thing happened early August with more bad economic data, and the last time we had VIX above 20 was last April. So this does definitely not happen too often. What exactly happened today, guys? Well, it was a case of everything. ISM manufacturing report coming in under the expectation. Then we had geopolitical headlines with Israel and Iran going at it again. This time, Iran launching over 100 ballistic missiles into Israel's territory. So we're gonna cover that topic as well. And news piece number 3 definitely has to be the port strike, which started last night, covering 14 different ports across the East Coast and the Gulf Coast, which is going to potentially slow down the US economy at a time where it really cannot afford to be had, right? So in today's video, guys, we're going to be going through those 3 news articles very briefly in the introduction. Thereafter, I have one earnings report prepared for you guys, and that is definitely going to be Nike with the biggest earnings report of the day for sure. So we're going to cover those in the second portion of the video. Thereafter, guys, we'll be going through our major technical analysis rundown of our major market indexes and our big tech names and see how are the markets shaping up after this massive 1 day's worth of sell-off. And at the end of the video, I figured I should present to you guys a few of the different swing trade opportunities that I'm seeing in the markets right now, and how we can also potentially hedge against a little bit of this volatility that's been coming at us really from all sides recently, right? So a lot to cover in today's video, guys. Let's jump right into the action. SPY down about 0.9%, QQQ down about 1.4%, but these numbers were a lot worse at the midpoint of the day. At one point, QQQ was down over 2%, and the SPY was down closer to about 1.3% before having some decent recoveries in the end of the day. So guys, in terms of the heat map, you will see that this was yesterday's trading, and this is pretty much today's trading. A lot of the damage to the downside was definitely done by semiconductors and a few of your big tech names pulling back a lot. Look at the technology sector, guys, down significantly today. Only Google and Meta making out of the action alive. Now, Amazon and Tesla also not having the best day. Financials for the most part too. Everything except for your credit card issuers were down. Healthcare as well, a more defensive sector, that was down too. Industrials, one of your lead sectors in the most recent weeks, those two were down except for your defense names due to the heightened geopolitical tensions right now. And energy was the bright spot in the market, once again due to the geopolitical concerns. Usually when we have some trouble in the Middle East, the price of oil always goes up and carries these companies along with it. Consumer defensives was a little bit of a mixed bag, but definitely, guys, not a very good day in the market to speak of at all. Take a look at your one-day relative. Energy, utilities, communication services to the upside. Everything else pretty much getting crushed, led to the downside by technology. Very unfortunate for technology, once again getting hit the most and the hardest. So before we get into more technical analysis, guys, what exactly happened? Let's cover those 3 news articles briefly. Number 1, we're going to be covering the port strike. So here it is. It started at 12 a.m. last night. The workers and the workers union and unfortunately the employers did not come to an agreement. So now we have a full-fledged strike, the likes of which we have not seen, guys, in the last 47 years. So it definitely has to be noteworthy to us. Let's go over a few of the headlines. The International Longshoremen's Association, the largest maritime union in North America, rejected an offer from the port management group USMX on Monday that included a wage hike over 6 years, near 50%. Yes, they rejected a salary increase of 50% over the next 6 years. This is a very decent offer by the management of their employers, right? Very decent offer, but I think I know what the problem is. Just because they rejected it, guys, is not the worst case scenario right now. At least management is making an effort to bring negotiations back to the table. And I think the reason why they rejected this 50% increase over the next 6 years, which is a very fair offer in my opinion, is possibly because the increase in salaries does not come much up front. Let me explain, right? So if you just divide 50% by the next 6 years, that's roughly about 8.2% per year. If you were to promise people 8.2% per year increases over the next 6 years, they may not take the deal. But if you were to offer them a 25 or 20% salary increase in year one and then streamline the rest over the next 5 years, they may be willing to take that deal because it offers them more money now when they want it now. So the offer is fair, but maybe the timing of the salary increases, that is what might need to be renegotiated between management and between the unions. So let's move on as well. A few more things to cover right here. A disruption of a week or two will create some backlogs, but the broader consequences will be minimal outside of a handful of very port-reliant areas, including Savannah, Georgia. Anything longer, however, will lead to shortages and upward price pressures. That's what we were saying yesterday, guys. A few weeks worth of disruption is probably not going to cause too much damage, but take this on to 4, 5, 6, 7 weeks, and that could definitely have an impact on the economy. We're going to follow this story very, very closely over the next few weeks. Hopefully it gets resolved sooner than later. The most significant issues would be faced by the food and automobile industries, as they rely especially heavily on the ports that will be shut down. While a surge in inflation is highly unlikely, even with a longer strike, even a modest reacceleration could create uncertainty and force the Federal Reserve to be more cautious about lowering interest rates, which would weigh on the overall outlook for job growth and investment. So very dangerous game that's being played here. Hopefully the government, the Biden administration also puts a lot of pressure right now on management for these companies to really come to an agreement with the unions very, very rapidly to prevent further deterioration of an economy that's already kind of struggling right now. We know there's a lot of red flags. We don't really need all these additional pressures right now. There's been a lot of bad news headlines over the weekend. Obviously, the hurricane coming and really wreaking havoc on the southern portion of the United States. Now we have the workers' strike as well, plus the geopolitical tensions, plus the already the fact that we have red flags in terms of unemployment rate slightly ticking up, output of the economy coming slightly down. We just do not need all of these additional external pressures. So if they can solve this conflict as quickly as possible, that will be the best case scenario for the markets, of course. So as of right now, no more new updates than that. We'll take this one day at a time. News article number 2, guys, that we're going to be getting into, of course, has to be the Israel-Iran events of today, right? Israel says Iran will pay for launching a major missile attack against it. Hopefully, this was to be the end of the conflict. This was obviously started just last week when Israel struck Lebanon. Unfortunately, well, depending on which side you're on, of course, right? Unfortunately, displacing a lot of people in Lebanon in the process as well, and killing the leader of Hezbollah, Hassan Nasrallah, in that attack in Lebanon, where they had their underground bunker, right? The Hezbollah underground bunker network. So let's get into the news article right away. Iran launched dozens of missiles towards Israel on Tuesday. Actually, it was probably closer to 100 or over 100 in what it said was a response to the killing of Hezbollah leader Hassan Nasrallah and others, potentially taking the region closer to a wider conflict. This is the problem. We do not want this conflict to escalate currently, guys. It has already been at this current point about a year since the events of October 7th last year, in which we know what happened when Hamas invaded Israel on its own territory and led to killing a lot of Israeli citizens in the process. Now, dozens of missiles piercing through the skies as sirens blasted across the country. At least one person was killed and several were injured during the attack, according to the Israeli military. Israel has vowed to respond to the attack, sparking worries amongst its allies that the conflict in the Middle East could escalate further. Now, this is why I said it worries me a little bit, guys. Usually, you would expect Iran to have a response due to the killing of the leader of Hezbollah in Lebanon, right? Israel has an attack, Iran responds, and then they come to negotiate. But now, take a look at what Israel is saying. Speaking hours after the assault, Prime Minister Benjamin Netanyahu said, "Iran made a big mistake tonight and it will pay for it. The regime in Iran does not understand our determination to defend ourselves and our determination to retaliate against our enemies." This is a little bit of a mixed point, right? Because Israel kind of attacked first. I know it's been back and forth here, guys, for pretty much the past year. That's not the purpose of the channel. The purpose is what is going to be the lasting impact on the markets. And if the Prime Minister of Israel right now is saying that Israel will respond, well, the increase in tensions, the increase in volatility could continue to plague the market for the next coming days. Moving on further, US President Joe Biden said the United States was fully supportive of Israel, but he said his administration was still discussing with Israel what kind of response would be appropriate. So for now, Israel is still on their own. The US not directly joined in the conflict. They are doing a few things behind the scenes, of course, everybody knows that, but so far, no major escalations in terms of US direct involvement in the conflict. So once again, we will keep a very, very close eye on this piece of news as well and the further developments. But one thing's for sure, guys, since Netanyahu is now saying that the conflict, that he will possibly respond to this most recent attack by Israel, we can estimate further volatility in the marketplace right now. So that is it for piece of news number 2. And piece of news number 3, guys, definitely has to be the ISM manufacturing report that came in early this morning. Take a look at this. The expectation was for about 47.5 on the PMI scale. It came in at 47.2. So under the expectation once again for now the third month in a row. ISM has definitely not been in a very good position as of recently. Take a look at the graph right here. You can see, guys, the output levels are just not very strong. Not as strong as they were back in late 2021, really at the lower end of the spectrum of where they should be in relation to the last 10, 15 years worth of history. So we know that manufacturing is weak, but this is for a few key reasons, which I'll get into very briefly. Then we also had the JOLTS jobs opening report, which shows that there are more job openings than were estimated, as approximately about 800,000 more jobs were opened than was the consensus estimate. So there are still a ton of jobs to be had right now in the US economy, but we're getting very mixed data with the economy, mixed data with jobs over the past 2-3 months, which is why I say there are some cracks in the economy right now. There are some red flags, but nothing is truly falling off an absolute cliff right now. So obviously the rate cuts will be helping this, but they take some time to come into effect, guys. So the volatility, in my opinion, especially in terms of economic data releases, will probably be persisting over the next 1 to 2 months of trading as we continue to battle with the data, conflicting data, some of it pointing to the fact that we're heading into a recession and others pointing at not, right? So we still have to be very, very careful in these markets right now. And piece of news number 3, guys, is definitely going to be, this is piece of news number 3. We're just going to cover the article real quick. Sorry, there's way too a lot today, right? So here is a little bit of what the manufacturers had to say. Now, keep in mind, guys, in terms of manufacturing output, we have to remember that because of the supply chain constraints that were arising in 2021 and 2022, manufacturers built out a ton of excess capacity, excess production facilities, and excess jobs as well. And now with the economy slowing down, they do not need all of that excess capacity right now. So when they start talking about manufacturing slowdown, a lot of that is just because they built out too much infrastructure, right? So we have to take these numbers once again with a little bit of with a little grain of salt and understand why this is happening too, right? There's really two sides to each coin. So let's move into it. Economic activity in the manufacturing sector contracted in September for the 6th consecutive month and the 22nd time in the last 23 months. This is just saying the fact that being under a read of 50 on this scale is what's known as contractionary. So that's what it means when it says 22nd time of the last 23 months. But it's true. Let's move in further. Demand remains subdued as companies showed an unwillingness to invest in capital and inventory due to federal monetary policy, aka rates are too high, which the US Federal Reserve addressed by the time of this report, and election uncertainty. Moving on further, what respondents are saying. These are leaders of their respective industries. Take a look at what they had to say. North American demand has started to weaken. Asian demand is slightly higher, but shows signs of weakness in future months. Chemical products. Global demand continues to remain soft. Fourth quarter forecasts have been further reduced, with several new programs shifted from 2024 to 2025. Manpower, working capital, and supplies are being flexed down in response. That is transportation equipment. Moving on further, the fourth quarter is slower than anticipated. We won't realize the effect of interest rate adjustments with new project starts until the first quarter of 2025. Fabricated metal products. Business is flat, waiting for interest rates to drop and the election outcome in November before we confirm our 2025 plans, currently planning on a flat 2025. Furniture and related products. Our sales continue to be flat. Our consumers are telling us that although our products perform very well, they are forced to seek lower cost components to maintain their sales. Textile mills, so clothing and apparel. Sales have slowed down this quarter compared to the same period last year, and we're adjusting production accordingly. Miscellaneous manufacturing. So as you can see, guys, everybody pretty much saying the same thing. They are seeing weakened demand and they refuse to increase investments in capital and increases in production capacity because rates are just too darn high right now. And that includes also hiring new people. They are still, as they say right here, still hiring to fill vacant positions in production and management, but not adding any new jobs. So that is the common theme across the entire industry. So hopefully that makes sense, guys. Once again, economic output front and center. So these manufacturing reports and every single economic output piece of data will be very, very important over the next 2-3 months and could sway the Federal Reserve's hand in either direction as to the pace of the interest rate cuts. If the data gets significantly worse, interest rate cuts are going to come faster than expected. But if the data still remains slightly weak, but still manageable as it is right now, expect the Fed to maintain its course of a more slower pace of interest rate cuts, the one they are on right now, as a matter of fact. And then the rest of the week, guys, tomorrow, big jobs data, private sector report early in the morning. And Friday, of course, another big one is going to be the non-farm payrolls. So the volatility this week, especially if the geopolitical tensions continue, the port strike continues, and we get bad news out of there, and jobs data is bad, guys. Expect further pullbacks in our markets, and we've been preparing for this at least for the past week and a half. I've been warning that the bulls are fairly weak at the all-time highs and that we could have some volatile news events coming up. Well, now they are here, so trade and plan accordingly. Now that that's out of the way, let's cover some earnings, shall we? Change up the pace and the tone rather. Let's get into some Nike earnings, right? And Nike coming in after the bell with their earnings. Unfortunately, the company is down 5.6%, right? So another unfortunate quarter for Nike, but I think everybody was expecting this one, right? The best we could have hoped for is possibly some very bullish surprises that Nike had not disclosed yet in terms of a new restructuring plan for innovation, a new sales mix plan as to how they were going to address their issues they've been having with wholesalers and competition, some plans possibly from the new CEO, but we did unfortunately not get any of it, right? A lot of people were looking forward to it, and myself included, but we just did not get it. All we got was fairly mixed numbers. So take a look at the earnings report right here, guys. In terms of the EPS and revenue, well, they beat on the bottom line. Very nice beat here on EPS by about 35%. And an ever so slight miss on revenue, but Nike was already guiding for the fact that the revenue was going to take a little bit of a hit this quarter. So let's jump into the article, guys, and you'll see through this article, I've highlighted a lot, and it's just because this article sums up my entire thoughts and everybody's thoughts about Nike currently. It does a very, very good job. So we're going to spend a decent amount of time on this article and then dive into the valuation and determine whether or not Nike's a decent bet right now. Before we do that, give me a quick second, had to get some coffee in. So let's have a look. Nike withdraws guidance, postpones Investor Day as it gears up for the CEO change. Definitely not a good start to the article, right? Let's continue. Nike on Tuesday said it was withdrawing its full year guidance and postponing its Investor Day as it gears up for a new CEO to take the helm. Last month, the company announced that CEO John Donahoe would be stepping down in October and replaced with longtime company veteran Elliott Hill, effective October 14th, so just in 2 short weeks of time. This provides Elliott with the flexibility to reconnect with our employees and teams, evaluate the current strategies and business trends, and develop our plans to best position the business for fiscal 26 and beyond. Now, they are suspending guidance, guys, in terms of an annual basis, but they will be providing guidance on a quarter-to-quarter basis. So guidance is still there, but they're removing it. They used to give it on a full year basis. Now they're not doing it anymore to give the CEO some time to assess the situation and plan accordingly. Now, moving on further, we continue to see indications of slight second half improvement in revenue trends versus our first half. As we plan to introduce and scale newness and innovation across the marketplace, we now expect gross margins to decline versus the prior year. Nike said it expects revenue in its current quarter to be down between 8% and 10% versus last year, and gross margin to be down about 1.5 percentage points. So getting hit on the top and bottom lines. That's worse than the 6.9% drop in revenue that analysts had expected. So once again, Nike coming in with terrible revenue guidance in relation to how they were performing last year. It's also postponing its Investor Day, originally scheduled for November. It's unclear when the meeting will be rescheduled. Very unfortunate for them. Maybe they just don't have any new innovative products to talk about. And that is a problem, guys. We've talked about this now for 6 months for Nike. Sales dropped to $11.6 billion, down about 10% from $12.94 billion a year earlier. That's exactly what they guided for this quarter. I said it yesterday on the channel as well. Sales would be down about 10%, and that's exactly what happened. Nike's gross margin grew by 1.2 percentage points in the quarter to 45.4, higher than the analysts' expectations. Still, profits fell by nearly 28% during the quarter, guys, on a year-over-year basis. Definitely not a good showing for Nike. Innovation. We're going to spend some time on this. That's why I highlighted it a lot, right? This is the problem. This is what happened with Nike. If you don't know what happened with Nike and you want a summary, listen closely. Over the last year, Nike has been accused of falling behind on innovation and ceding share to competitors as it focused on selling directly to consumers through its own websites and stores rather than through wholesalers such as Foot Locker and DSW. At first, the strategy was a boon to Nike's profits and sales during the COVID pandemic, but as it scaled, it got more complex and customers started returning to stores and other in-person activities. Now, what's the problem, guys, when you take off all of your shelf space in Foot Locker, DSW, and other retailers such as Dick's Sporting Goods and other wholesalers as well? When you cut your inventory, you cut your merchandise, you cut your display windows, right? Who is there to fill all that other shelf space? All of your competitors, Adidas, Hoka, ONON, ASICS, and the list just goes on. Huge misstep by Nike for allowing competitors to enter into their shelf space where customers are seeing these brands more than they were before, right? They're seeing competitors more because now they have more shelf space, right? Just makes complete sense. And now competitors are stealing market share from Nike that otherwise I would highly doubt that they would have been able to do. Now, moving on further. During the quarter, Nike direct sales were down 13%, while Nike digital sales were down 15%. So now even their strategy of direct-to-consumer sales is backfiring. Sales online are also down. Critics say Nike's focus on direct selling also led it to take its eye off innovation. Under Donahoe's leadership, the company grew annual sales by more than 31%, but it got there by churning out legacy franchises such as Air Force Ones, Dunks, and Air Jordans, not the groundbreaking styles that turned the company into a global powerhouse, meaning they were doing more of the same, focusing on the same brands that they already had, right? The same shoe styles, no innovation, and that was a mistake. Sales for those legacy franchises are no longer boosting sales in the same way they had previously. What's happening with those brands? Glad you asked. Listen to this. Online sales for Air Force Ones, Dunks, and Air Jordan 1s combined were down nearly 50%. That's not a small number, guys. That's huge. Jordan brand alone was down double digits during the quarter, and the company expects it to be down at the same rate for fiscal 2025. Absolute destruction of the brands, guys. I've been following Nike for a long time. I have never seen those legacy brands down, not even by 25%, guys, but to be down 50% is absolutely unacceptable, guys. Nike has dropped the ball in more ways than one over the past year, and definitely we know that. But now is time to see if they have the strength for a recovery story through 2025 and 2026, right? So the company also expects overall online sales to be down double digits in fiscal 2025. Another piece of bad news. Wholesale, let's address those concerns. Last year, Donahoe started to acknowledge Nike needed to mend its relationships with wholesalers. Wholesalers have previously spoken out about Nike's product lineup and how the same old recycled franchises weren't doing enough to drive sales. Sounds oddly like Disney's movie franchises when they were being criticized for this about 6 months ago. CEO finally acknowledged it, and now they're turning the page with fresher releases. Hopefully Nike will take a page from Disney's book. Two completely different businesses, but some of the same things that were plaguing two completely different companies. Now, Nike's fiscal first quarter wholesale revenue was down 8%. Compounding the issue is the overall sneaker market, which has been relatively stagnant in the US, and a slowdown in consumer spending on discretionary goods such as new clothes and shoes. That we know, so they have a lot of headwinds to deal with as well. Here's your sneaker market in the US. What do you notice? Extremely flat over the past 4 years. Now, this is the entire sneaker market, guys. This is not Nike's fault exclusively. It's just people are tapped out. They did a lot of their spending back here in 2021, and now nobody really hunting for new sneakers anymore. I assume people have purchased most of their sneakers 21 and 22, and now that the economy is kind of teetering a little bit with consumer discretionary spending down, people definitely not shopping for shoes as their first bet. Footwear sales in the US are projected to grow by just 2% in 2024 compared with 2023, after barely budging between 2022 and 2023, as we said, right? During the most recent quarter, Nike footwear sales in North America were down 14% and apparel sales fell 10%. Where do they stand on China as well? Traffic was soft in the region, and Friend, who is the CFO of the company, said that Nike is not immune to China's challenging consumer environment. So not much positive out of this earnings report from Nike, unfortunately, guys. I was hoping to hear a little bit more on the earnings call. I listened to the earnings call, but no concrete steps were given. We're probably going to have to wait for the new CEO to come into place on October 14th. He's been at the company for a very, very long time, guys, over 30 years. He knows the business inside and out, so it's not as if he has to learn the business at a first glance, right? So I'll be very curious to hear about Nike over the next month and a half, and possibly some of their steps to address the wholesaling issues, the innovation issues, and stuff of the sorts, right? So not a very good report by Nike, guys. Nike is still in the midst of a massive turnaround story that, in my opinion, is going to take years, not months, years at this point, right? So let's move into the valuation, right? So the valuation in terms of Nike right now, well, they're still growing revenue at about 5.1% per year. Very weak in terms of the brand's history. EPS is growing still at 11% per year, doing very good in protecting their profits as best as they can. Here's their Nike profit margins over the last 15 years, roughly. You can see that they haven't fallen off a cliff. They've fallen, but they're on the road to recovery. They've done good in terms of cost efficiencies and inventory management. That I will give to them, but it's in terms of their top line revenue growth that matters the most, right? You can only cut costs so much and manage inventory so much. Eventually, you're gonna have to grow the business, right? So their profit margins, gross on the top line right here, gross margins are not too bad. They're roughly the median of the company's history. Your operating margins also not terrible, right? Roughly slightly under or arguably in line with the bottom end of the company's history. And your net margins as well, sitting at about 10, 11%, which is roughly the average of the last 15 years. There's some ups, there's some downs, but they're managing profits as best as they can. And I think, guys, that is the only one saving grace for this company that's allowing them to keep their share price high right now, is they are protecting the EPS growth as best as they can while their revenue declines, unfortunately, right? So some positives, some negatives, but that's just the fact of the matter. Now, moving on to the forward P for 2024 at 84 bucks, you can see the forward P even for 2024 is 26.1. It's not a tremendous deal right now. This is the company's relative historical average, right? If you don't believe me, let's just pull it up real quick. Can I get it? Yeah, let me just pull it up right here. PE ratio, right? So you can see the PE ratio right now, literally the company's historical average, right? No surprise there. It's not expensive. It's not cheap, to say the least. When we divide that PE ratio by the forward EPS growth rate for the next couple of years, we get a PEG ratio of 2.38. Anything under 1 is good. Between 1 and 2 is okay. Over 2 starts to get a little bit high, guys. So Nike at a 2.38 PEG, even though the company is down significantly, I wouldn't say the company's cheap. However, they do have a very attractive free cash flow yield. I will give them that at above 5%. That is very good. Usually we look between 2.5 to 5%. Closest possible to 5% is the best you can possibly get. At 5.1, this is very, very good. So where do I stand on Nike right now, guys? Well, Nike for me is a buy in a 70 handle. Think, as close as possible to 75, right? 75, $70, I start to get interested in building a position. But as we approach the higher $90 range, that's where I kind of start to draw the line, right? I want to buy this company when nobody wants to buy it. If we get some fear-driven sell-offs, the economy starts tanking, the indexes fall apart, everything like that, that is where I will come in and buy Nike, but I'm in no rush to buy them in the $80 range. They can keep their shares, not interested. I want the 70 handles, 75 all the way to about 70 bucks. That's when I really start getting interested in this company. Suffice to say, they are still trying to protect the weekly uptrend right now. We'll see if they can keep that underway, guys, but I'm really looking for a deeper discount on Nike. And as I said, since this recovery story is going to take a lot of time, I don't believe there is any rush to buy Nike stock right now. I think we still have a lot of time to possibly accumulate some positions below the $80 mark. So hopefully that makes sense for Nike earnings. Now, moving into our technical analysis portion of the video, give me a very brief second. And let's jump right into it, right? So we know what we were expecting on the SPY so far over the course of the week, right? We were talking about the fact that the bulls were in a very, very nice daily uptrend right now, and we were looking for the daily higher lows for possible further trend continuation. So that's still what we're looking for here, guys, right? The daily higher lows are all the way down here. 560.5 is the daily higher lows. The bulls are still working with a little bit of space and coming into a big area of support down here, right around our daily higher lows, which is 564 down to about 559. So we do still have space. We do still have support. I would not rule the bulls out just yet for the possibility to set up a daily higher low and maybe move a little bit higher. However, if the data continues to remain negative over the course of the week, no solution to the port strike, continued escalations in the Middle East, and possible bad jobs data that's coming out either tomorrow or on the Friday session, right? Well, we may just have a little bit of a daily trend rollover to the downside. That would still be fine because on the weekly, we are still in a very nice weekly uptrend. We would then just be looking for a weekly higher low, anything pretty much above 538, looking for that weekly higher low for possible further trend continuation. So a little bit of volatility, a little bit of downside would not be the end of the world, guys. The bulls still have the longer term timeframes, and until we lose those longer term timeframes, I will remain cautiously optimistic on the markets. I have some hedges in place right now. A lot of my portfolio is still positioned long, but I would be lying to you guys if I would tell you guys that it's not prudent to have some hedge positions to the downside. And we'll get into that towards the end of the video. Moving on to QQQs right now, same concept as the SPY. Beautiful daily uptrend on the Qs right now. Looking for the daily higher lows, anything pretty much above 470.29, looking for the daily higher low for possible further trend continuation. Now we are coming directly into our area of support. 483 down to about 478, challenge the bottom end of it today. In the event we lose this here, guys, the bulls will be giving back too much of the move. It opens the door for lower high into lower low, daily downtrend. And at that point, you'll be looking for the same thing, looking for a possible weekly higher low for further trend continuation eventually. At that point, anything above 447.49, 447.50, let's call it, is just going to be a weekly higher low for further trend continuation. So a little bit of downside could be warranted in the Qs. Just keep an eye on your weekly levels, guys. In my humble opinion, it's going to matter a lot more than your shorter term price action on these indexes. We want to get a general sense of who is controlling the larger timeframes right now. And as for right now, it is the bulls. So all of these uncertainty catalysts are still buy the dip opportunities in my opinion, but be very selective with the quality of companies that you're looking to do. Only the highest quality companies should be deserving of your hard-earned money. Now, moving into XLF financials down about 0.53% today as well. So financials still shaping up for a little bit of tightening range action right here. But we're going to be mindful of the break, guys. Break of last Wednesday's low, 44.66, and that would unfortunately be a new daily downtrend on the XLF. And then at that point, we would just be looking for continuation of the tightening range on the weekly. As of now, no major red flags on financials, but we have to be mindful that, if they do not form a new all-time high and continue this daily uptrend, head into a daily downtrend, and you guys can see the pattern, right? Basically a tightening range. Now, keep in mind, the bulls have been in control of this weekly uptrend for a very long time right now, so it's going to take a lot for them to lose it. How would they lose it? Lose 43.41 to the downside. That would be weekly downtrend. And then we'd be going into further monthly consolidation, which could take a lot more time to resolve. But as of now, the bulls not looking too bad. Just keep an eye, guys, on those larger term levels in terms of the weekly timeframes. Those will be very, very important coming up in the next few weeks. Moving into healthcare right now. Healthcare down about 0.53% on the day. Another bad day for healthcare, right? Few healthcare stocks were down a lot, especially Humana today. Humana down a whopping almost 12% on the day, but the rest of the healthcare sector as well was overall down too. Not much green to be had in the markets. It's known as a more defensive sector, but as of recently, guys, it has not been performing too well. It was having a very good time in the later part of the month of August, but now it is the first major sector in a weekly downtrend. So at this point, guys, lower highs are probably trying to be set by the bears. We are working against this level of resistance above us and all the moving averages above us as well. In the event we flush last week's lows, daily downtrend will simply be maintained, and we just continue this weekly downtrend as well. I would not be surprised if they take it right down into our area of support, which I've labeled with this green box right here, 151 down to about 150. That's going to be the big area to watch here, guys. Any further breakdown of that, and we will just continue into further monthly consolidation, right? Healthcare is not looking too bad on the longer timeframes at all. Eventually, we still need these 1 to 2 months of periods of consolidation, and healthcare is going through one of those right now. We're probably going to see a very bullish end to the year for healthcare, talking about November and December, but October could be a little bit choppy for the sector. So one of the names that I'll be looking out for, guys, in terms of the swing trades, I'll talk about it later in the video too, is going to be TMO. I like TMO in terms of the price action structure right now, so we'll include that at the end of the video. Moving on further, SMH. So SMH also down a whopping 2.68% here today. Semiconductor is really not getting any love whatsoever, right? Since they've peaked pretty much in July, it's been a lot more red than has been green, right? Extremely choppy price action, which is why I maintain the best way to play this sector right now has to be with short puts. We want to benefit from the volatility because we know that the markets apparently are not in any single rush to bid these ones up higher as they were with these tremendous rallies that started, late 2022 and then all the way into 2023 and 2024, right? You can see we've literally been doing a whole lot of nothing for the past 4 or 5 months at this point, and I do expect that to continue at least until we get into the semiconductor earnings, which are coming up in the month of October, right? So another day of decline after getting rejected in the zone of resistance up here, 257 down to about 249. Now rejecting and coming back into our big area of support. Still have a daily uptrend capacity to be protected right now, guys, but they need to turn it around quick. If we take back any much more of this move, you open the door once again for the bears to set the lower high and lower low crush again, erasing this beautiful daily uptrend that they've been working on since early September. So we'll keep an eye out for that right now, and that would just mean a tightening up of this tight range of accumulation, right? Would not like to see them lose the bottom end of this green box of support right here, the bottom end of which is about 224. So I really do believe, as I've been saying on the channel in the most recent weeks, guys, it's not the first time you've heard me say this, right? I think we're just going to maintain a tightening range until the earnings season starts in mid-October. Moving into the Russell, growth stocks also down today. Makes sense, right? Economic concerns, geopolitical concerns. It's still not the environment, guys, for growth stocks to run, in my humble opinion. There's just too many red flags at hand right now to give this market a green light to just push growth stocks to the absolute moon like everybody's expecting with the rate cuts, right? Too much uncertainty on the table, so that's why you won't have much support in terms of price action. And a lot of this resistance period from 2020 and 2021 going to be tough for the bulls to break through that without clear economic skies. So the Russell, also a sector, daily downtrend now underway, which means we are in for weekly consolidation. And similar to SMH, guys, I think the best that the bulls are going to be able to maintain here is somewhat of a tightening range as we move through this economic uncertainty right now. So I'll be looking for possibly a retest of the 210 down to 208 location right here. need for them to protect this and kind of tighten up this range. As long as we can tighten up the range above this area right here, 210 down to 208, this chart can still be maintained in a healthy fashion and potentially start getting higher as we move into the November and December seasonality period, which might prove to be bullish for the markets and could give the Russell the much needed bump that it needs to start challenging the above area of resistance. But for now, in the month of October, everything that's been happening today, as well as the jobs data coming out, election uncertainty, so much other uncertainty right now. October may just not be the month for us to rally in the Russell. I'd be taking a closer look at this one in November and December. And lastly, moving into the Dow Jones. So the Dow Jones down about 0.41% today. Not that bad at all, right? So moving on higher, daily uptrend. Now, as I was saying, guys, keep an eye. Daily uptrend is maintained, but keep an eye right here, 41,853. If we lose this area, loss of the daily uptrend, you set up the bears for the daily downtrend reversal, and you set yourself up for a little bit of weekly consolidation. Good thing though, the bulls have a ton of space on these charts right now. Anything above 40,000 pretty much, just gonna be looking for a weekly higher low for possible trend continuation. The 12 EMA is right there, and our last area of support is there as well, which is pretty much 41.3 down to about 40,000, 41,000-ish. So if you're looking for a little bit of a swing trade on the Dow Jones, I would be looking for this zone of confluence as my next entry point for those swing trades. Now, taking a look at one of the sectors, guys, that's really come alive today with good reason is energy, right? So energy has obviously been out of favor for quite some time now, to say the least, and that's been a byproduct of the weakened barrel of oil, right? We know that oil right now is at multi-year lows. It has only been this low December of 2023, and then May of 2023 as well, and then November of 2021. So multi-year lows for the barrel of oil, which has kind of kept the energy sector relatively muted. Couple that with the fact that usually in the fall, you have some weak seasonality for oil overall, just because the summer boom is kind of finished, right? Less people going on road trips, less people possibly traveling as well. So that's why, through planes and trains and cars and everything like that, right? So that's everybody's back to work, the kids are back to school. So it's very normal that you have a reduction in the demand for oil prices overall. But now we have an external factor that is kind of helping to counteract that weak seasonality, which is geopolitical tensions. This one is a very decent sector, guys, as a hedge for those geopolitical tensions, right? If those tensions escalate either in the Middle East or with the Russia-Ukraine situation as well, that this sector could do fairly well, in my humble opinion. Obviously, it's kind of unfortunate that you're kind of betting on oil. If you want this to go up essentially right now, you're kind of preying on escalating tensions for war headlines, essentially, right? So kind of an unfortunate factor there, but you kind of got to follow the money at a certain point, especially if you're trading, right? We kind of have to remove the emotions from trading and just focus on following the money and stuff like that, right? So energy could be a very decent sector. They are mustering up a tremendous rally over the course of the day today. If we break higher than, let's say, 91.73, I think the bulls kind of have it in the bag for a little bit of weekly trend expansion here. I would not be surprised if that could be the case. And a lot of your oil stocks, OXY, for example, had a tremendous rally off the lows today. Could be due for a little bit of a comeback. CVX, I talked about this one on Saturday, coming out of a nice area of support, multi-year low area of support, looking very good, and other oil companies as well, right? So that is one sector that could attract a lot of attention in the upcoming weeks, right? So just had to say a little bit of a tidbit on oil as well. One of these sectors that could be a defensive play for all these escalating tensions, right? The port strike, geopolitical tensions, bad economic data. I've talked about it for a while. This definitely has to be 20-year bonds. It is a natural hedge against economic uncertainty and international uncertainty as well. And keep in mind, guys, interest rates are coming down, which has a natural effect of boosting bond prices too. So this is kind of a, it's kind of a double bonus, right? Not only are rate cuts coming down, which will bring TLT grinding higher over time, but any escalation and uncertainty, whether domestically or internationally, could give this one a boost as well, which is exactly what happened over the course of the morning today. So this one could be a good hedge play moving forward. If you're looking to hedge against a little bit of uncertainty, keep in mind we are still trying to protect this weekly uptrend. I think they will have it in the bag. And this is just because look at these long-term 20-year yields that TLT is based off of, right? We are embarking on a longer form monthly downtrend, and I expect that to continue. So TLT, in my humble opinion, is not going to be an NVIDIA trade, right, guys? These are bonds. It is not a tech stock. We're not expecting them to do this, but a slow grind higher is probably most likely in the cards. So that's pretty much everything for that one right there. Moving on to Bitcoin very briefly, then we'll tackle our big tech names. Bitcoin coming down tremendously today, 4%. It's a risk on asset, right? And when we have so much uncertainty in the markets right now, internally, domestically, with the port strike and everything else we talked about, ISM manufacturing, and then external conflicts as well, such as Middle Eastern tensions, stuff like that. Well, obviously, this is a risk on asset, right? And all the news we got today stimulates a risk off environment, right? People flock to bonds, they flock to gold. A lot of people say that Bitcoin is the digital gold, but that's not globally accepted by the institutional community, right? By a lot of retail investors, it is. When we are talking about the big money that flows to bonds, to gold, to the Japanese yen in times of uncertainty, that same money does not necessarily flock to Bitcoin. The institutions flock to Bitcoin as a risk-on asset. For now, they still have not changed their mindset. They don't view Bitcoin the same as they view gold right now. I'm not saying I view it that way. I'm just saying how the real big money views this trade, and they're the ones that move this chart the most, guys, whether we like it or not, right? We have to acknowledge, we have to say it how it is pretty much sometimes, right? So Bitcoin kind of coming undone because it's part of the risk on trade over the last 2 days. That being said, we have also now lost the daily uptrend, loss of the higher lows right here. So any further move to the upside could just be looking for a lower high into lower low and possible daily downtrend continuation. But the bulls have a lot of space right now, right? A lot of space on this weekly chart to set up for a weekly higher low. I'd be more keen on looking for, right around here where we are right now, right around the 60,000 mark. Need the bulls to kind of put a stop to this at the lowest point, 68K. Need for them to set up for a higher low to possibly maintain the capacity for a weekly uptrend resumption, possibly towards the end of October into early November, when the rest of the market usually has some very positive seasonality. Into November and December, we usually get a nice rally. So I would like to see them protect these lows during the month of October and then go for it. One thing's for sure though, guys, if we come back down to this location, guys, under 60K, talking about 58 all the way down to roughly 55, I will be a buyer of Bitcoin again. Every single time it's came down to that area, I have swing traded it and added a bit to my long-term holdings, and it's always been a good thing so far. So I'll continue to do the exact same thing. Now, moving on to our big tech name, shall we? Moving on to Apple. Apple was down over 3.5% at one point today before finally setting at about 2.91, not having the best day at all. And Apple right now is kind of stuck. Very, very, very weird price action, right? They tried for the daily uptrend breakout, equal highs, triple top right here at about 233, could not get it done once again. And now not only have we broken down, we have flushed the most recent daily higher lows, right? So very, very, very wide range on Apple right now. Watch for the break of this lower area right here, 224, guys. If we break and close below 224, suffice to say, no new highs into lower lows. That would be a daily downtrend. And once again, we would be heading into weekly consolidation on Apple. So as of now, no weekly uptrend has been confirmed. Triple top by the bulls. We will see how the week ends, but we have to be mindful that in the event we lose this area on the daily, we're probably going to use this as resistance, set up the daily downtrend, and maybe even revisit the lower 219 down to about 214 level, which would just be the bottom end of this wide range. Apple has pretty much been trapped right now. So very, very unfortunate for short-term breakout capacity right now. But we'll be watching for those lower levels. Once again, I maintain, guys, for me, there's no trade on Apple right now. I just don't see the risk reward benefit for the company. The PEG ratio is way, way, way too high. The revenue growth rate is still being challenged. iPhone 16 release wasn't the best in terms of the initial the initial pre-orders and now the sales in store. The Apple Intelligence is also still not being implemented on the devices by Apple just yet. It's coming in about a week and a half's worth of time. So still need to get a lot of people used to using it, review videos and stuff like that, right? So Apple right now, still in a little bit of a, it's kind of trapped, right? You know, we don't really have the catalyst to really push this blasting towards the all-time highs. But there's also not so much negativity that we can warrant a massive sell-off, right? So I will be very patient. I've told you guys where I want this one. I want this one below 210, as close to 205 or 200 as possible. Where it is right now with the valuation, it's just not for me, guys, for a swing trade. I still maintain my long-term shares, of course, not selling any of those. But right now, this one is a hold. It's not a buy. It's not a sell. It's just a hold for me. And for swing trades, I need a better deal. I need it closer to 200. Moving on to AMD. So AMD right now down about 2.64%, unfortunately being unraveled with the rest of semiconductors, but the bulls do have a lot of space, right? Nice daily uptrend. And now we're looking to set up for the daily higher lows. Anything pretty much above 148, looking for the daily higher low for possible further daily trend continuation. Now, what I do not want to see AMD do, guys, is lose this red box that we just recaptured. Support from back here, congestion, huge congestion, resistance as well. This area needs to be defended very, very hard by the bulls. We broke out of it, supposed to be using it as support, so they need to come and play defense over the next few days here, guys, for AMD to be able to protect its capacity at resetting into this new daily uptrend, continuing the daily uptrend, and continuing the weekly trend expansion as well. In the event we come too low, guys, we take back too much, once again, they'll have to use this area as resistance above. That will probably be setting up for a lower high and maybe lower low. That could possibly send us into further weekly consolidation, right? And at that point, even if we do have weekly consolidation, it'll be unfortunate because we'll be losing the capacity to break out further, but we'll still have a lot of space, guys. Anything above 132, looking for a weekly higher low for possible further trend continuation. So we'll take a close look for this one day at a time. One thing's for sure, as we move further into the 155 area, the best way that I can possibly play this stock is with short puts. I'll be looking for short puts in the mid 140s, possibly for next week. Moving into Amazon right now. So Amazon not performing too poorly today, down about 0.64%, not being spared though by the negative news headlines, especially that port news, since it is one of those ones that's affected by shipping, of course. So daily uptrend on Amazon, but now unfortunately we cut the daily higher low. So Amazon now losing the daily uptrend and losing this area of support that was above us, 190 down to about 187. This will now become resistance. So there's always a capacity right now for a lower high, get rejected, and lower low. That would be daily downtrend. And at that point, guys, we'd be looking for further weekly consolidation on Amazon. They have a beautiful weekly uptrend right now and tons of space, right? Anything pretty much above 169, just looking for a weekly higher low for further trend continuation. So Amazon, same concept, right? As we drop further, I will be looking to write short puts 180 and below, 180 all the way down to 170. As we progress further and further lower, I will be writing short puts under the market, giving myself some margin of error to work with here, but I would not mind picking up any shares of Amazon under 180. Love the company, love the valuation down there. So that's just how I'm going to be playing Amazon looking forward, looking for that weekly higher low, writing short puts possibly in the mid 170s. Now moving on to Google. Google up today, 0.74% and finally getting the daily uptrend breakout confirmed, right? So looking very good, getting slightly rejected right now. We're coming into the area that I would not be surprised, especially if the rest of the market continues being weak this week, would not be surprised if Google's momentum kind of gets killed in this area, guys. Big area of resistance above us, 171 up to about 178. That being said, beautiful daily uptrend right now. So still any move lower, going to be looking for a daily higher low, anything pretty much above 162, looking for the daily higher low for a second attempt at this range. If we do not blast into it right now, can possibly do the two-step process into it, and then we will reevaluate how it reacts once it gets there, but definitely working with a lot of overhead resistance on Google right now, but it's good. The bulls are looking fairly healthy, right? And now we finally have a decent size weekly recapture underway. almost 100%, right? Well, we can pretty much call it 100%. So I love to see these 100% engulfing moves because now even if Google shows a little bit of weakness with the rest of the market, they have so much space, guys. Anything above 148, looking for a weekly higher low for possible further trend continuation. So that's what I'll be waiting for on Google myself. It serves me no purpose to buy it here into resistance, right? I would rather wait if we get overall market consolidation and Google kind of unravels here, loses this, and comes back and retests maybe the lower 160s. That's where I would be interested in buying Google. But the valuation right now is still very good, even at about 168. It's just at 160, 158. I like it a lot better. The PEG ratio is darn close to 1 at that point. Now, moving into Meta, give me another brief second. So Meta not looking too bad today either, 0.7% to the upside, and the bulls just doing what they do best on Meta, guys, grinding higher, right? New daily uptrend in motion on Meta right now, looking very good. Your next target of resistance is the 600 psychological just above us. Your daily higher low is right here at about 555. So Meta with two options. Either we just continue this daily uptrend into 600, or in the event they are plagued with overall market weakness and we roll this over, flush these lows, well, at that point, guys, you'll probably be looking for the lower high into lower low. Daily downtrend will be started, and that's okay. Why? Because look at the space we're working with here on Meta. Beautiful weekly uptrend in motion right now. Any move lower on the weekly, looking for a higher low, anything above 496, looking for that weekly higher low for further trend continuation. And I swear to goodness, guys, if we pull back into the 540, 530 location, breakout, retest of the previous 6 months of all-time highs, I will be buying this trade opportunity right there. It's going to be a beautiful breakout retest trade. I've been waiting for this one for a while. So if it does come, that's the type of trade that I'm looking for on Meta. As of right now, guys, not really any trade opportunities for me. I'm really going to wait for that weekly pullback. Now, moving into Microsoft. Microsoft down 2.23%. Look at the closing number. I'm not going to say anything, but it's a pretty funny number, right? Anyways, so Microsoft closing right here at 2.3% to the downside. Daily downtrend is clear as day right now, right? So daily downtrend is for sure. And unfortunately, now we have lost the area that we were looking to protect. This is kind of like exactly what Apple tried to do, right? Trying to break above the area, or sorry, not Apple. We were looking at Amazon, my bad. Amazon, exact same thing, right? Supposed to use this area as support, and unfortunately, we just blasted right through it. So very unfortunate for Microsoft, but what are we looking for here, right? Well, any bounce will probably just be looking for a lower high into possible resistance, lower high, and maybe continuation of the downtrend. How do you end these downtrends, guys? Well, you guys know, need to wait for an engulfing move, and then higher low, higher high, get the uptrend back. Now, that is what I'm expecting to happen eventually. Why? Because we have a bullish bias. Weekly uptrend is gorgeous on Microsoft right now. So at this point, I would not be surprised if we are just looking for a little bit of a weekly higher low, right? Anything pretty much above 401, looking for the weekly higher low for possible further daily trend continuation. Coming up into big support down here. The closest one is about 416, 417, which is the height of these guys right about here. So we're coming into it very shortly right now. But one thing's for sure, guys, if we break all the way back down and Microsoft just gets trapped here, it wouldn't be the first time. Microsoft has done that a bunch of times over the course of the entire year. And worse comes to worse, guys. In the event we retest the lower 400s, you know the drill. I will be buying the same as I did the 2 prior times. Usually a very good buying opportunity for Microsoft. But as of now, the longer term bulls do not look too bad at all. Keep in mind, all these big tech names have earnings coming up in about 3 weeks worth of time. Moving into Netflix right now. Netflix holding up better than a lot of other big tech names, right? 0.44%. And we know that Netflix is now above the prior all-time high range of resistance. This zone right here between the 2 dotted lines, 698 down to about, let's call it 700. 700 down to about 676, right? 25-point range. Looking fairly good, not going to lie, on Netflix's front. Have not lost the daily uptrend. Still trying to set up the daily higher lows. Continuation of the trend is probable at this point. Why? Because the weekly still looks good for some expansion, right? Netflix is just grinding higher right now. I know the candle formations don't look too good, but suffice to say, even if we get some more extended pullback, just looking for a higher low for probable further trend continuation. At this point, Netflix has earnings coming up in about 2 weeks worth of time. So it'd be nice for them to put a little bit more space between us and this area of the prior all-time highs. Hoping for them to hit at least maybe about 750, which would not be too much, right? Not asking too much for Netflix, just a little 5-6% push. prior to their earnings. If they can do that, they really create enough space that even if earnings are poorly received, well, at least we have a nice fallback location, a lot of space, right, to fall back into the prior all-time highs, set some new higher lows, and then maybe reset from there. Now, moving into NVIDIA. NVIDIA down 3.66% today as well. NVIDIA trying its best to protect this daily uptrend, but giving back a lot of space right now. Yes, we are still protecting the range of support, 119 down to 114, but one more day of red like this, and we are quickly going to challenge the daily higher lows, and you may just set up for a daily downtrend reversal. And at that point, guys, probably just going to extend, same as the rest of semiconductors, right? Tightening range, same as we got last fall. So this has been what I'm kind of been expecting. I was going to say predicting, but I don't like predicting, right? It's kind of the expectation, right? I would not be surprised if we just end up in a massive tightening range until the earnings cycle comes out for semiconductors and they reiterate that the growth, Q4 growth and all through 2025 is going to be phenomenal. But for now, we need to take these trades one day at a time. For me, the only way I'm playing NVIDIA is on these big red days. I'm going to be looking to write short puts, guys. Where? Below 110. I want 107, 106, 105 as close as possible to 100 as I can get. The bottom end of the range that we are trying to protect right now. So that's just how I'm playing NVIDIA. At this point, guys, I'm not trying to make any crazy plays for NVIDIA continuation. I just don't think we're going to get it much before the those companies come out with their earnings, which are all going to start about the midpoint in October in about the next 2 weeks. Now, before last, Tesla, let's take a look at Tesla, 1.38% to the downside. Tesla at one point today, guys, was down substantially, right? They were down almost 5.5% before recovering a lot of it today. Now we're pretty much getting the Tesla delivery numbers probably right about now. I hadn't seen them at a first glance right now. They'll probably be out tomorrow, as a matter of fact. So we'll cover those on the channel tomorrow. They might be out right now, but it's just I'm filming right now. I don't want to spend too much time looking for the news article and then just going through them live with you guys. I'd rather prepare a little bit. So that being said, guys, delivery numbers tomorrow, price action going to be highly dependent on those delivery numbers, of course. If they are good, let's see if we got them in the after. Did we get anything in the after hours? Any movement whatsoever? Let me just turn on the extendeds right here. No, nothing, right? So probably due for tomorrow. They may already be out, as I said, not really reflected in the share price, probably out by tomorrow morning. So delivery numbers and then obviously earnings coming up in 2 weeks and the robo-taxi event. A lot of bullish catalysts, but just remember, guys, dealing with a lot of overhead resistance right now. So if we break through this 265, you can see it's been challenging a lot of times for Tesla. 265 has been challenging. If we break above, the next area, guys, definitely has to be the $300 psychological level of resistance. So if we break above, you guys know that is the target to be looking for. Daily uptrend looks very, very healthy right now. So any pullbacks such as today, going to be looking for a daily higher low for possible further daily trend continuation into the robo-taxi event, into earnings as well. The weekly also looks fairly good too. Beautiful weekly uptrend. If we get rejected big time because of deliveries and maybe the next 2 weeks of price action are weak leading into earnings, just remember that we are just looking for a weekly higher low for further trend continuation. And at that point, the next big area of support probably comes in at about 235 down to about 230. So Tesla not looking too bad right now, but highly dependent on 3 big news catalysts that are coming out over the next 2 weeks of action. And now lastly, Palantir. So Palantir down about 2% on the day. Not the best day for Palantir, but at least not falling off an absolute cliff, right? Still struggling with the overhead $38, $39 level of resistance, which is the last one from 2020 and 2021. So we'll see. Are they going to be able to do it, guys? Or will we cut these lows? If they cut 35.86 to the downside, that is going to be a new daily downtrend on Palantir, and that would just be for a very healthy weekly consolidation. This is the scenario that I'm looking for to add to my Palantir position, guys, for a few swing trades. I want to see a little bit of a pullback, right? So that being said, in the event we break to the downside because the rest of the markets remain weak, well, that's what we're going to be looking for, guys. 35 to 34, right? If we can get as close as possible to this location, anything above 29 is just looking for a higher low for possible further trend continuation. The 12 EMA is right there. If we pull back into this location, guys, right, 34, 33, I'll be looking to write short puts a little bit under that. 32, 31, going to be slightly conservative with this one. But as of right now, guys, the bulls are in full control. We just have to acknowledge the fact that Palantir is quite expensive right now in terms of the PEG ratio. Very good company right now, but I would be more keen on waiting for pullbacks to go for longs rather than trying to go long into direct resistance right now, right? So that's just how I view Palantir. This one, in my opinion, is going to be highly dependent on the performance of the overall market moving forward. Now, that's pretty much everything, guys, for today's video. So hopefully you enjoyed that. Now, in terms of the swing trade opportunities, well, we covered a few of them, right? There's obviously the trade on oil that I was talking about. There's a few stock-specific ones, right? We talked about oil. We talked about gold being a good one as well. We talked about the TLT trade being very interesting. But a lot of the companies, some of the companies that I'm currently looking at, guys, in terms of just technical setups, right? Number one has to definitely be O'Reilly. O'Reilly looking excessively good. Look at this monthly uptrend, right? Absolute powerhouse of a stock. A lot of that is due to, increased buybacks by the companies over time. But look at this weekly trend, right? Weekly, nice little uptrend right there. Consolidation, breakout right now on the weekly. So going for a new weekly uptrend leg right now. Look on the daily, guys. This has now been since July, right? Very tight range of accumulation. You get the breakout, you got the retest, and now ready to run. So O'Reilly, one of my prime candidates right now for a little bit of continuation rally to the upside. Would not be surprised if this one can fracture the $1,200 mark maybe over the next few weeks. Another one that I was looking at, guys, with a relatively similar setup is Thermo Fisher Scientific, a healthcare play, right? As you can see, two dotted lines are going to be the area that we just broke out of. It's a breakout retest trade to begin with as a whole. This is the weekly time frame too. So nice little weekly move up, looking for the retest of this range, which they're doing perfectly right now, and possibly looking for the trend expansion right here into the higher 650, 660 level. So I would not be surprised right now, guys, if that would be the case over the next maybe 2, 3, 4 weeks of trading. Looking very good. The fundamentals of this business, guys, is absolutely amazing. I don't know if you know Thermo Fisher Scientific. Very, very, very strong company, guys. Beautiful EPS expansion, beautiful revenue expansion as well. Great profit and great net profit margins, great internals, and also most of your analysts are either at a buy or a hold with price targets well above the current price. So everything really points to this one being a fairly decent play. Now, play number 3 that I'll be looking at, guys, is UPS. And this one definitely has to do with the port strike, right? So the port strike, we know what's going to happen. People are going to have to divert all of that traffic to somewhere. A lot of it's going to go to the West Coast, but a lot of it could also be moved onto air freight. And there's only 2 companies that do air freight in the world, pretty much, right? And that's going to be FedEx and UPS. Now, UPS, they do not have their earnings yet for another 3 weeks, and they are currently in a very nice, beautiful technical pattern of expansion, daily trend breakout, retest of the moving averages, and retest of the same range, high end of the range that we just broke out of, right? So this 132 area could be good for some continuation trade with those port headlines into maybe the 140 location for a profit target. Not looking too bad at all. And we just got the first weekly uptrend, possibly due for a little bit of continuation. But UPS, it's not NVIDIA, right? Sometimes it moves a little bit slower than expected. So I may be expecting a little bit of a grind higher here into the $140 range. So that is pretty much, trade number 3. And possible for another, some possibilities here for another little swing trade is Texas Roadhouse. So Texas Roadhouse also doing a very beautiful breakout retest pattern on the technicals, right? Notice how most of these are going for continuation of an uptrend, right? Those are the ones that I'll be looking at recently in terms of some continuation. So Texas Roadhouse, same thing. Big range of accumulation at the all-time highs here since the month of May, right? Tight. A little bit of downside right here. Now what have we done, guys? We've broken out of the top end a little bit here. Look, breakout and now retest of this range, talking about 174 down about 171. Retest of the range could be due for a little bit of a swing trade to the upside, guys. And the upside targets will have to go with the psychological numbers. 190 is probably going to be the next target for Texas Roadhouse, looking for the weekly trend expansion and just continuation. Look, monthly bull flag right now, looking for some continuation. So figured I should give you guys some of those trade ideas because those are the ones that I'm looking at the most aggressively right now, rather than taking you guys through another portfolio recap similar to the one I just did yesterday. So those are just a few fresh ideas. I've been giving you guys a lot of trade ideas over the past few days. So hopefully amongst everything that I've presented to you since Saturday, essentially, hopefully you've been able to find one that perhaps you would have liked as well. I give you guys the hedge trade ideas as well. So take all of that as you will. So hopefully you guys enjoyed today's video. If you did, consider dropping a like, would appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. Would love to have you back here. We do these every Monday through Friday after the close. And lastly, guys, if you have any questions at all, especially in times of high uncertainty, always feel free to ask me down below. If you want me to look at a specific stock, give my opinion on it. If you want to talk about an options play that you need a second opinion on perhaps, or maybe you want to discuss the macroeconomic news that's happening right now and possible implications, always feel free to have a discussion with me down below in the comment section. Would love to talk to you guys. So take care. See you guys tomorrow after the close, and peace.